Hey everybody, Brian here from quantlabs.net. Going to be whizzing through the automated and algorithmic trading pros and cons. Okay, so I'll be presenting tonight, who am I, algo trading benefits, top billionaire trading hedge fund managers, why we do it, algo trading challenges, your goals in trading, and I'm also going to be talking about the next four. So it says optional here. Automated backtesting, your risk management arsenal, the revolution of high frequency trading, and your programmatic broker choices here in Canada. Can be pretty well universal for any of the across the globe, really. Okay, so who am I? My background. Well, my first computer was a VIC-20 when I was at the age of 14. I'm not a real fan of jobs or consulting. I run a blog called quantlabs.net. Also been at 5 years of researching trading technologies now for coming up to 5 years. Next section, algo trading and the benefits. All right, so here's some stats in the finance industry that will be useful for people. 73% of all U.S. equity trading volume is driven by high frequency trading. Upper base salary for the highest performing financial quants out there, usually the base of $500,000, up to 80 or even 90% of retail traders will fail, and $5 trillion are traded daily in foreign exchange markets. All right, so what are the skills needed for being a successful algo trader? Well, top is 30% math, tech knowledge at 25%, innovation at 15%, industry usually 5%. What are the trends in investment banking? There's an article out there called Rise of the Quants at Goldman Sachs. These two guys, Don Dewey, Paul Walker, installed as the co-heads of technology, and they basically said that the strats have taken over and they are using them as a source of innovation. Also recently there was an interview over at Bloomberg TV. Is software going to take over Wall Street jobs? Another trend that was identified by Holy Grail a little while back, they said that the Holy Grail of trading has been found. The HFT firm only had one losing day, 1,238 days of trading. The founder, Vincent Viola of Virtu Financial, became the first billionaire from high frequency trading. Now, automation will allow you to have scale to infinity, profit potential at exponential levels no human trading educator or mentor will ever have or give you. The risk management pretty well is limiting, never kind of works out when you use emotion or intuition as part of your trading. For a fast-moving market, you have to ask yourself, how do you know the exact position weighting you want to take on before it could have a negative impact on your portfolio? And from my perspective, I'm using an archaic broker with lackluster reports, and it pretty well makes you use primitive guesses to make trading decisions. In summary, you need to remove human emotion and improve your statistical chance of being wrong at 50%. Also, with automation, you can analyze things like option chains or future sets of contracts in real time, for instance, trading decisions. Pretty well humanly, it's not possible. Even if you were trying to work against the trading machines, you cannot really use past data as future indicators unless you have the technical infrastructure to implement it. Also with automation, you can do deep market depth analysis instantly for multiple trading opportunities. And most of all right now, machine learning is a trend, but it's only to be implemented by PhDs, otherwise not recommended for use, as it is not proven to be any better than trading a S&P 500 ETF, let's say. Okay, so why do we do all this? Usually when you look at the top billionaire hedge fund managers, there's a couple of trends we need to be aware of. The big one is the common DNA I find is they're usually using quantitative analysis or high frequency trading. So the top five, starting at Israel Englander, who made 900 million over at Millennium. Also, Bill Ackman is more of a corporate trader. But number three, Ray Dalio is a quant guru, runs Bridgewater, made 1.1 billion. James Simmons, number two, math genius, took his firm, being really one of the first high frequency trading shops out there, made 1.2 billion. Now again, this is their salary. This is what they make, not their firm. The highest for 2014 was Kenneth Griffin, who founded Citadel and made 1.3 billion, and is a big fan of HFT. So what are some of your challenges in algo trading? I find as a human, you're pretty well most likely leaving money on the table. You'll be trading as a human can really hold you back. 80% of all your trading volume is driven by automated algorithms. Electronic trading, including HFT, is part of that. A lot of people don't know this, but your broker will sell you out. Unless, and there's usually, from this article, I found that only 4 brokers have direct market access, and those should most likely are not selling you out by selling your order flow to HFT shops. So you need to think now, what are your goals? Well, number one goal would be one of the 3: profit, buying shiny toys, retaining your portfolio so you never lose. It should be you want to retain your portfolio so you never lose. Can you trade as a human? Sure, if you want mediocre returns at best. Not sure if 20% is it, but definitely most likely under 10% annual returns. But then even as a retail trader, if you are a financial relying on financial institutions, you're usually only going to get 1% annual return. If you're lucky and they consider you valuable, they might give you 2%. We won't be happy about it. Some people will go to desperate measures to spend thousands of dollars on gurus for an education that makes you quote unquote smarter. Basically, these guys will just take your credit card and don't really care about your longevity in terms of your success as a trader. Now, there's some concepts out there where some will think that if you sit in front of more screens, it will make you more profitable, or even better platforms. Obviously, it doesn't work. Now, this is from the perspective of an independent trader. We could look at PhDs, CFAs, CSEs, and then obviously we get an alphabet soup for indie traders, but it comes down to WTF, and you got to ask yourself, well, what does that give you? Just pretty well gives you credibility. That's pretty well it. And then we have this little Mimi from Mimi Beaker, and it'll get the biggest bowel movement ever. So as an indie trader, who's going to be your final judge? Well, it'll be the markets. No matter how many alphabet letters you got on your business card, that is pretty well the final judge. And then again, you got to ask yourself, what are your goals? So there's a lot of people that just really don't care and just chase after shiny toys. And don't forget the odds that are against you as a human retail trader, where 90% of your retail traders, 90% of all retail traders will lose 90% of their money in 90 days. So is there a chance? Also, for human Forex traders, a lot of them won't even use money management in Forex trading, and they like to live dangerously. Also, we hear about this thing called automated trading, and I go on about the infinity and beyond, scale to infinity. We talked about the benefits, the control, which I didn't mention. It's a big one. If you have your own source code and the knowledge that goes with it, and of course the scalability. So you have to ask yourself, when you combine the human and automation, Well, don't forget, your number one goal is to retain your capital. Never lose capital. Even Warren Buffett believes in it. So, what are the important steps as a human? Top three, probably research, research, research. Where can you go? Good examples are apps on your mobile device, Bloomberg TV, Bloomberg Market, magazine, news. This thing's free except for the mag. Also, you could go to Morningstar. You get really good info on ETFs, stocks, pro tips, hedge fund newsletters, and economic news. Also, you when you do combine it with automation, you want to make sure you use your own tools and software that you trust. Specifically, if you write it, that's the preference. It's what I do. So if you refresh, what are your goals again? Hopefully that will make you rethink. So that brings us to where we need to talk about all this. Now, the big one is automated trading. Is it valid? Now, there's a lot of mixed views on this. Typical workflow would be traditional backtesting involves using 80% of a data set, implement the algo rule or model, forward test the balance with your algo on that 20% of the same data. And then the question comes down to, is this valid? Is it what most automated traders should do when they backtest? Well, there's this book we all should know about, Walk Forward Optimization. Some may have read this book. I'm always interested to hear what people think. Then there's also what I believe is the random walk theory that stock price changes have the same distribution and are independent of each other. So the past movement or trend of stock price or market cannot be used to predict its future movement. Anyone may or may not believe in it. Now, here's what the critics say. They contend that stocks do maintain price trends over time. In other words, that it is possible to outperform the markets by carefully selecting entry and exit points for equity investments. Not sure what kind of automated traders would support that. So the question comes down to, is backtesting valid? According to my friend Dr. Ernie Chan, he basically says this: backtesting is just a way to instantly reject the proposed model, algo, strategy for trading. I find that very true. Now, there are a lot of people out there that will get bogged down in backtesting questionable trading algos, or they'll just manipulate the backtesting process to fake their model to potentially show it's profitable when the results prove it's not profitable. Now, when I did my webinar today, it was like, yeah, well, they do that for marketing reasons. That's what the scammers do. Okay, so my theory is, if you go to this link here, themathworks.com, download a project that I've demoed on with source code, commodity trading. Basically, this commodity trading project will run various back tests on data sets and contracts and be compared against each other. The charts will show what commodity sectors are most profitable in different snapshots with different time periods. And there's different metrics used here. There's the Sharpe, Sortino, CAGR, otherwise known as the compound annual growth rate, and max drawdowns. Now here's a chart. If you look at it, each one of these lines would represent a different sector. So you can instantly see which is going to give you a higher return under different time periods. Now, what happens if these sectors change from time to time? What happens then? Well, you need an automated system to be able to dynamically adjust to that. Another thing is that we need to be aware of is these different factors here. So what we have here are the different metrics. So we have CAGR, max drawdown, Sharpe, and the Sortino. And same here as well. Different results of different metrics. Now, one question may come up is, why don't most traders, especially human traders, use something like Sortino versus a Sharpe ratio, where the Sortino differentiates harmful volatility from general volatility by taking into account standard deviation for negative asset returns. And then here we should be asking, why don't people use this ratio in a highly volatile environment, blah, blah, blah. But this is just one example of what automated trading will give you. Now, of course, there's lots of queries that come with it. I'm not going to get in these. And the next part we want to talk about is risk management. It's obviously critical to stay in the trading game. There's many forms of risk management. One's called VAR, value at risk. Maximum loss not exceeded with a given probability defined as a confidence level over a given period of time. Now, there's also extreme value theory. In statistics, any way to estimate or measure the likelihood of an extremely unlikely event. That is, extreme value theory measures the probability that the data point that deviates significantly from the mean will occur. You can use it in insurance to measure risk for catastrophic events such as tornadoes and blah, blah, blah. Another way to evaluate risk is a CDF, or the cumulative distribution function. Probability theory and statistics cumulative distribution function, or just distribution function, describes the probability that a real valued random variable big X with a given probability distribution will be found to have value less than or equal to little x, and on it goes. Now, we also have implied volatility. This is a forward-looking indicator where the market is bearish and decreases when the market is bullish. This is due to the common belief that bearish markets are more risky than bullish. So if you're really into this stuff, you want to understand risk, I'd highly recommend you get this book from Attilio Miucci, Risk Asset Allocation. Now, let's talk about high frequency trading, the revolution of it. A lot of people come to me and ask me about trading research, how to get into high frequency trading. There's three factors you kind of need to look at. Research the programming language. You need to factor in time versus expense of any open source you choose. And we also have to factor in how prone to errors will it be. So for instance, if you're using research programming languages such as Python or R, both are really not future-proof. The packages can be also out of sync with the core version of either Python or R, whichever you use. The other thing you got to factor in is the quality of the mathematical results. Especially if you're going to be using one package written out of an operation that's been developed in a garage kind of thing. The other thing with both these languages are painfully slow. They try to focus more on parallelization or clustering. And what you'll end up doing is probably having to integrate it with C or C++, which kind of complicates it or can really limit your system's capabilities. Now, the other factor is you got to factor in time versus expense of the open source. Yeah, it's free, but it costs time as well. You could do it yourself approach or take that approach, as many programs do, but they never reach their expectations. There are smart commercial software out there, gets the job done, but just remember that you will run into various issues with third-party software developers. Again, all of this can be error prone. If you're going to do it your own, are you professional enough to accomplish all this? Do you have the confidence in your developing team if you hire somebody or a team? Last section we need to address here is going from zero to hero, because whatever ways you automate, everything does come down to your broker. So for Canadians, as I said, even for global, we need to factor in all this, but we're really limited just to two brokers at this point. First, our goal call ourselves a schmuck with ambition in a computer that can change your life. We want to automate trading from end to end, but at the same time we want to be a one-stop shop. We also want to focus on best-of-breed technology to accomplish all this. And pretty well our brokers are either the Forex broker Oanda or broker number 2, Universal Asset Trading. It covers all the universal asset classes, and it's fairly API friendly as well. So the advantages of Wanda has minimal funding, full access to the API sample using REST or Java. Has also a very strong mobile app for paper trading, but there's some cons with it as well. It's very limited for your assets, so you can only really choose Forex, some major commodity and indices. Could have questionable spreads, trading execution, and market making mysteries we'll leave it at. And also you need to factor in the time needed to develop connectivity tools for your own trading algos and models. Now, the second broker Interactive Brokers with the pros covers all the major asset classes, including stock, forex, options, futures, etc. Supports all the programming languages that matter: C++, C#, Java, with the fixed protocol. Also offers you the ability to demo for testing with no account creation, and it has multiple routing options, including IEX, the one that was from Flashboy's fame as well. Now, some of the disadvantages: cost you need about $10,000 to fund, and there's still those market making questions. Now, if you're really interested in what I do, I've got all these social channels here on YouTube, Twitter, Facebook, and LinkedIn. You can also join my weekly events, any of these meetup groups, and we do try to have weekly online events via Meetup. Hope this helps you out. Talk to you later.